Well, it's my privilege to have first crack at commenting on these. I think there's an awful lot we can say. I want to start, as traditionally the case in academics, I want to compliment each of these authors on the quality of their empirical work. I think given the nature of the hypotheses they try to test, they've done the best they can do with the data. I like the comprehensiveness of the analytics, the attempts to control the appropriate kinds of variables. So I want to direct most of my comments to the institutional pieces related to these topics. And before I do that, I have a couple of comments just in general about the nature of deposit data. So I'm going to rely on some of you community bankers to assist me in this. Based on what we heard yesterday, even this morning with Governor Quarles, when you focus on branch data, the first question that jumps to my mind is, what is a branch? So I've been teaching for 40 plus years, the last 10 of which, when I had senior classes, I'd take a survey. And the last 6 to 8 years, when I asked them what their branch is, you all know, you academics know, what does a college student think the branch is? Right? This is it. So when we generate branch data, what is the process for allocating deposits, transactions attributable to online or mobile businesses to different branch outlets, to headquarters? I don't know. I've asked several of you community bankers here, asked some folks who teach technology classes at the Graduate School of Banking, and the answer I get is it's somewhat subjective, that there are no absolute criteria. It could be based on location, but the bankers have far better data than these researchers have. And I would ask you bankers, do you track your virtual bank separate from the physical branches that you have? Because most of what I read talks about the decline in transactions at physical branches, somewhat related to the kind of data we're seeing today. And in reality, isn't that how you make the decisions as to what branches to keep open, what branches potentially close, et cetera? So my first issue or concern is, what is the quality of the branch data that all of these academics are looking at, or the researchers at the Fed types? And I'm not sure I know. And how much can you, as an organization, influence that? All right, the second one is, in my mind, if you look at balance sheet management at a community bank, you have much more flexibility on the funding side than you do on the asset side. So your assets are driven by the demand for loans, which you can influence somewhat with your pricing. But on the funding side, if you lose a core deposit, you have numerous alternatives to replace that funding. You can offer to pay higher interest rates. You can substitute wholesale funding. So when you look at the impact of competition on deposits, to me, you have to differentiate between the nature or the composition of those liabilities. Are you looking at just core checking, core whatever? Because the response to me would be, focus on the mix. We're going to talk a little about credit unions. I have a banker friend in the Maine market who says in his market the credit unions buy CDs. So he uses brokered at a lower cost than what he would have to, at his organization, pay for the traditional core deposits. So if I were to suggest one thing about the analytics, to the extent you can, control for change of mix in the liability side. All right, so let me talk about the three papers briefly, and then I look forward to hearing Gilda's comment, because she is in this business and frankly has a dog in the hunt. So let's talk about the first paper in credit unions. And so I'm just going to roll the ball out here for you community bankers. It's difficult for me to listen to a paper on credit unions where you don't talk about their two real competitive advantages. The first one is the tax advantage, correct? They don't pay income taxes by and large, and in many states, they don't have to pay sales taxes, right? So how do credit unions operationally take advantage of that tax benefit? Well, anecdotally, since I'm not in the industry, what I hear is they choose an asset class, typically car loans, or maybe a funding source, the CD market, and they lower the rates they charge on car loans, raise the deposit rates, and so in effect, you're getting that competitive result that you find that we perceive as good for the community, maybe, but it clearly is a competitive disadvantage for a bank who doesn't have the tax advantages. All right, so the second one is, obviously, what is the common bond that used to limit or restrict who could operate as a credit union. Now, I really like what Ram did with your event study, effectively looking at this change in allowing or encouraging low-income credit unions. But I thought I'd have a little fun, so I went online and looked at what the Pentagon Federal Credit Union was advertising, because it has been in the news for the last couple of years about its aggressive acquisition policy. The CEO has come out and said, we're going to triple in size by 2025, which means they're going to go from the low 20 billions to 75 billion. They've done 5 or 6 acquisitions. And so I go on their website, and what I see is big banners right up front that says, pricing on new car loans is as low as 0.99%. Pricing on used car loans is 1.99%. Now, I'd ask you community bankers, which of you are willing to make me a new car loan at 0.99%, and I'm all in. So they're buying a market, effectively, all right? So then I said, well, how can I become a member of PenFed? And if any of you have tracked this, it's pretty fascinating. I say the Pentagon Federal Credit Union. Down at the very bottom, for other, since I'm not military and don't have the other criteria, here's what it says, and I have to write this down. If you don't qualify in any of these other ways, you can be a member, no problem, if you make a one-time $17 donation to a charity, Voices for America's Troops, or the National Military Family Association. So what is the common bond if you're going to be at PenFed? Now, so in part of my research, I came across this quote. This is fascinating. This is J. Mark McWaters, NCUA chair. He requested that Congress allow credit unions to expand their definition of common bond to include people who, I quote, share web-based communities as a basis for their credit union charter. So those of you on Facebook, start a credit union. Those of you who tweet, start a credit union. So how does a credit union take advantage of this unlimited common bond in some sense? And I'm really going to let Gilda talk about some of the mechanics, but they have a tax advantage. The thing I say is you change your pricing, or you expense preference. I'm going to pay my people better. I'm going to have better facilities, or maybe I'm going to go after competition by going after market share in terms of expanding this credit union base. So I'm a little uncomfortable reading this paper without knowing more about the credit unions that have chosen low-income status. So the recommendation I'd make to you, Ram, on your paper is simply give us the underlying data as to the attributes of, I can't remember how many actually flipped. Was it 2,000? A couple of thousand. So are they in, how big are they? Are they in rural? Are they in MSAs? Now, I'll give you my intuition, and this just comes from limited knowledge of what I know about credit unions. I think there are, and I'll maybe offend some of you community bankers, I think there are 2 basic business models. On average, the smaller the credit union, the closer they align with the traditional common bond. They don't expand, typically, their common bond outside of the original focus of their organization. And that's one of the reasons they're probably under 100 million in asset size. I suggest on a policy basis, Congress would have much less trouble leaving their tax advantage firm and maybe changing the tax advantage of the biggest credit unions like the Pentagon Federal, who choose and want to be commercial banks in the commercial loan markets and the like. So from a policy perspective, I think Ram's paper has enormous implications. If you're going to argue that the entry of credit unions lowers the cost of borrowing to consumers, raises their deposit rates, whoa, what's to stop us from arguing that we should let any big credit union do commercial lending, which is going to lower commercial loan rates, increase credit availability? It's fraught with policy implications that I think are non-competitive. Okay, enough about that. I'll let you community bankers pile on later if you want. Let me say a few things about Troy's paper and your colleagues. I really enjoyed reading this paper. I found myself nodding all the way through this as to, yes, that makes sense. That's my intuition. And so I want to read some of his conclusions and just ask you community bankers if this doesn't make sense. One of his first conclusions is large bank mergers are typically in MSAs. Well, isn't that where the growth is? Isn't that where the economic growth is? Isn't that where the population density is? If I'm going to start a de novo bank, am I going to go in, I'm from Iowa, am I going to go into rural Iowa? Or am I going to go into Des Moines in the corridor up 95 where the growth is? So it's not surprising. Why does the acquiring big bank want to be in a low or no growth market? If you presume that, then I think the rest of your conclusions just naturally flow, incredibly logical, having to do with the performance in the non-MSA markets versus the MSA. I did like the finding that there's no evidence of a robust negative relationship between large bank mergers and small bank vitality. I remember I used to teach in Texas before I was at University of South Carolina. Before I went to South Carolina in the 80s, I remember a bank, and I believe the Fort Worth market had one of the best advertising campaigns I've ever heard. And it was something like, if your bank has changed names recently, maybe it's time you should change banks. So I would suggest many of the community bankers in this audience and across the world, exactly like your data suggest, don't mind a mega bank coming into their market because they're going to see the customers flow. So when I say I'm sitting there nodding in agreement, I think this makes total sense to me. And I love the way you control for MSA, non-MSA, rural, non-rural. So let me briefly comment on your paper, Mika. Obviously, like many of you here, I'm a community bank advocate. So when I saw the word scandal, I went, ooh, scandal, not good. I would substitute for scandal political activism. And if you ask me a question, do I think political activism influences customer behavior? Absolutely. And I think that's what you are showing. Do I think that is a scandal? No, I think we're measuring something different than the word you're implying. So just part of who we are as academics. I went in online, I took his 9 banks, and much like he did with Wells Fargo, I put in the name of the bank, and then I put scandal, and I put 2012 to 2017, just to see what would pop up. And so I'll read you some of the things. And I'm not going to go through all of these, but every bank of the 9, other than SunTrust, had I wouldn't say a lengthy list, but had a list of significant scandals. All right, the first one, LIBOR rigging. Quite a few of these banks were involved in LIBOR rigging. Wells Fargo, he went through. Citigroup, just a subset. Overcharge on credit cards. This is what they've agreed to, paid fines for, et cetera. Overcharging credit cards, misleading student loan borrowers, manipulating the value of South Africa currency, LIBOR rigging. BBVA, history of money laundering all the way through. BNP Paribas. Guilty plea for violating U.S. economic sanctions. They submitted false claims to the Ag Department. Penalty-related criminal charges for helping U.S. customers evade taxes. Sumitomo, insider trading, loans to organized crime. Same with Mizzou. So the bottom line is, how do you control for when a scandal starts to have an impact on a bank? I'm not sure you can when you look out a window 2012. So it's an obvious question you're going to get asked as you present this all the time. Do you have enough controls to limit this? Now, I want to emphasize a couple of very positive points. One particularly on the last one, Mika. And you and I talked a little about this. If you see deposits flowing out of the large banks based on political activism, I would suggest it's not just savings banks that are getting some of the benefit, or credit unions. I would suggest it's also community banks. So if I were in your shoes, I'd run a simple test, given that we're co-sponsoring the seminar with CSBS, maybe just put an indicator for banks that have state charters in the markets in which you work. And I'm guessing with a pretty high probability you're going to find that these funds flow to community banks as well. With that, let me tee it up for you, Gilda, and appreciate hearing a true banker's response to this.